Influencer property gurus online had you thinking that building a $10 million property portfolio is simple work, and most people believe them. But the truth is, $10 million portfolios aren't built in a year, they're built in decades. They're built through strategy, patience, good decision makings, and time in the market. I'm Matt Alal from Byfair Property Group, and I've helped over 300 Australians to acquire over $200 million worth of property, with 50 plus million in capital growth achieved and an average of over 6% rental yield outcomes for each of those properties across the portfolio. I've done this using the Byfair Investment Blueprint strategy. So in this episode, we're going to unpack the exact blueprint that will get you to owning a $10 million portfolio so that you can enjoy the lifestyle that you dream of and live that lifestyle that you knew that you could build. Starting with point one, focusing on the strategy, not the outcome. Now, the outcome will come. It's a byproduct of delivering or acting upon a strategy that's going to get you to where you want to be. Now, $10 million sounds impressive, and it is, but it's the process that matters more. And it's sticking through those challenging periods where you face your fears, where you're concerned, where the market goes really good and you want to sell some assets, the market's going really poor, you want to sell some assets, so on and so forth. But most successful investors start a lot smaller than people think. And it all begins with the first property. Every journey begins with the first step. That's why it's important to understand. Most people struggle with the first thing that we love to talk about, which is analysis paralysis. Analysis paralysis is one of those things that holds people back from making a decision and not overcoming their fears to get that decision going so that they can get into a property. They spend too long focusing on looking at properties, researching properties, assessing properties, yet the only thing that they're not doing correctly is actually buying properties. They're too scared that things could go wrong, so they don't decide at all. They sit there and they do what we call the analysis paralysis. Now, a very favorite saying of mine is that it's not about timing the market that matters most, it's about time in the market that matters most. It's not my saying, but it's a critical thing if you're going to achieve a $10 million portfolio, that you're going to have a portfolio for as long as possible. And if you hold off 6 months on that first property, it might mean that you miss out on a peak in the market, which means that you might miss out on the second property. It might take 3 or 4 years longer than what it would have to get into the second property, so on and so forth. And that compounds over a long period of time. Remembering that we're talking about decades here. We're not talking about a couple of years to build a portfolio of that nature. The second thing that I see, which is really important, is that most investors don't actually work with an expert. A professional tennis player will have world-class coaches teaching them to be the best that they can be, and they will pay them for that. A lot of people want to save money and they think that they're saving money by not working with an expert. At the front of the show, that might be the case because you're not actually paying anything up front. However, what happens is you end up paying for it by a number of different things. It might be that you pick the wrong property in the wrong area and the outcome is a 2% capital growth performance as opposed to a 6% capital growth performance over the long term. The experts definitely are more likely to achieve a better return in that respect because they're probably assessing the areas in more detail and know what to look for. It might be that the rental yield is 3.5% as opposed to 5 or 6%. Which makes a big difference in follow-up borrowing capacities and limiting what you can do for further purchases. It might be that the person who's doing it on their own doesn't know how to structure the financing of an expansion for their portfolio properly, whereas the expert will structure it properly. I know lots of different ways where we can reduce tax, where we can pay off your family home a lot faster, where we can expand quicker, which is going to get you to that $10 million mark faster than if you're doing it on your own. An expert's going to put you in contact with the right people. It's going to give you an army of advisors. It's going to give you contacts in the industry that are going to help put the plan together for you and help you deliver upon that plan. So whilst it might feel like you're saving some money up front by not having to pay an expert, especially the long-term outcomes, very likely to not be as impressive than if you do it on your own. So the importance of starting in 2026, the market doesn't need to be perfect. The earlier you start, the more time compounded growth has to work for you. Waiting for certainty often delays progress. Time in the market versus timing the market. and working with an expert that matters most. Long-term holding periods and cycles are where normal wealth is usually built over multiple market cycles. If you're interested in understanding how to build wealth for yourself through property, Buy Fair Property Group offer a guaranteed 6% or we pay rental yield investment plan that removes the risk of vacancy and aligns to the investor's advantage with all of the government changes with capital gains taxes and negative gearing changes. To learn more, there's a link below in the description where you can book a call with my team to see if we can help. Point number 2, building financial foundations first. Now, what we mean by this, and I touched on it briefly in the previous slide or previous section, is understanding what kind of structure you need to be able to expand into further properties. Now, it's really important to understand that the difference between getting to, say, a $5 or $6 million portfolio in 20 or 30 years' time and, say, a $10 million property portfolio in 20 or 30 years' time might only be one property different. It might mean that you have 5 properties in your portfolio as opposed to 4, or it might mean 6 properties as opposed to 4, so on and so forth. Now, one of the key ways that we need to approach this is at the start, when we structure your financing correctly. We make our money when we buy properties. We don't make our money when we sell properties. So getting your structure correct is very, very, very important. It's a mistake that I see people make very, very often, and they limit themselves from being able to get themselves into multiple properties. Now, one of the biggest advantages to owning investment properties is leverage and compounding growth or compounding returns. Now, the more properties that we have working for us, the more chance that we have of being able to achieve that $10 million number that we're trying to hit here. Now, your structure is very, very critical. For example, a lot of people cross-collateralize. They might have a family home with Westpac as a guide, and then they want to go and invest into another property. A lot of people will actually go and get the investment loan from the same bank that they've got their family mortgage home in, whereas that can actually lead to a lot of complications and limit your ability to be able to get into more properties faster down the track. Another mistake that I see is not setting up the equity loan correctly, and then also not setting up the structure once you have the first investment property to make sure that you're utilizing that to get the family home paid down quickly. Quite often they'll have principal and interest structures in the wrong place as well, which will actually limit what kind of tax advantages they can have. And it's a really serious thing that happens quite often. The second thing within this point is cash flow management. Paying your family mortgage over a weekly or even a daily payment. If you contact the bank and say, hey, I want to pay my family mortgage off daily, firstly, I can say this, is that they're probably going to try and talk you out of doing that. But when they're trying to talk you out of doing that, it's probably for a good reason, because it's costing them money and saving you money. So one way that you can do that is cash flow managing your own mortgage that you have, and then also utilizing the cash flow management of the investment property or multiple investment properties that you're acquiring. Now, I see this mistake happening a lot as well, and that is that people don't actually understand what the numbers are on that investment property or those multiple investment properties until they get to the end of the financial year, when they give the documentation to their accountant. The accountant submits everything, quite often leaving out information that needs to be input in there. For example, depreciation. I see quite a few investors who have investment properties and don't actually have depreciation schedules attached to those properties, which is essentially missing out on free money. If you have a new home as an investment, depreciation is a massive, massive advantage that you need to be capitalizing on. And then also structuring that in a way where you're getting paid your tax return faster. There's ways of doing this through PAYG variations, which you can work out with an accountant or one of your army advisors, which will make a huge impact in paying off your family home if it's structured correctly. So what we're trying to say here is that if we're structuring things correctly from the start, it might mean that you end up with 4 or 5 properties as opposed to 2 or 3 properties in 20 or 30 years' time. And that's going to give you a much better chance of getting to that $10 million value than if you don't set it up correctly. It's almost going to be guaranteed to be a better chance than if you don't. And then a lot of people make the mistake of actually buying the wrong asset class. It might be that they want to get adventurous and they want to get into a commercial property, or they want to get into an industrial property, or they get into the wrong type of residential property where they just don't know how to make the most of that asset and how to get the best outcomes from that asset. They might also go into markets that really don't support the strategy. I do see this a lot as well. For example, staying within the affordable space protects you from downswings. The property market doesn't go backwards very often, but if it does, or if it stagnates, it's the affordable space that's protected, because it's the most active and the most people are operating within that range. So if we're acquiring properties that don't put pressure on our cash flow, especially if they're achieving a stronger yield, what that's going to do is it's going to strengthen our borrowing capacity for the next one. However, in the opposite situation of buying an investment property that's a lot more expensive with a lower yield, that's going to have the opposite effect. It's actually going to limit our borrowing capacity and once again limit the amount of properties that we're going to be able to have down the track, which will affect our end outcome. So yeah, point 3 is the right asset allocation. So there's a number of things that come into play with that. Firstly, affecting the borrowing capacity, as I just mentioned. If we're picking the wrong asset, it's going to affect our borrowing capacity in a negative way for future properties. You still might be able to get into a second investment property if you make the wrong decision with the first one, but it might mean that it's limiting your ability to get into the third asset or the fourth asset or the fifth asset. A lot of people block themselves from being able to expand because they choose something too early on in the process that's too expensive. A good example of this is if the bank says to you, hey, you've got a borrowing capacity of $1.5 million for an investment, and you go and spend $1.5 million on an investment. What do you think is going to happen if that property doesn't perform very well and you want to go and get another asset? It's probably not going to happen. So BC is very important, borrowing capacity is critical, and knowing how to manage that so that you can expand faster. Most people know that the housing market generally increases in value long term. However, not many people know that some areas actually don't increase in value long term. And there's reasons why that is the case. It might be that an area's got too much supply, for example. There might not be many people moving there from a population standpoint, which is causing a supply and demand deficit. So there might be too much supply and not enough demand. Now, the housing market can't really increase if that's the case. If there's 10 people selling houses and only 5 buyers to buy those houses, then it's a buyer's market. The prices are going to have to be negotiated down as opposed to whether there's 5 properties on the market and 10 people trying to buy them. That's then a seller's market because we've got more buyers negotiating for the purchase of that property than we do houses. And then another point to that is your income. Sometimes your income does plateau and that affects your borrowing capacity in the future. But once again, that really comes back to the income of the properties that you're purchasing as well. As I mentioned earlier in this podcast episode, Buyfair sell properties with 6% guaranteed rental yields, where the average rental yield in Melbourne, for example, is 3.7%. So we're nearly doubling the average rental yield within a region. And that gives you a much bigger potential to be able to expand into more properties in 2, 3, 5, 10, 15, 20 years time, especially if you duplicate that approach. It's going to strengthen your position and the bank's going to be comfortable to give you more money when you're looking to acquire the next asset. Point 4, the next one that's really, really important here is to have patience. Having patience is critical. So strategy over speed is something that I see all the time. Most investors fail by trying to scale too quickly. Buying one strong property can be a lot more powerful than multiple poor properties. So patience is often underrated. For example, not selling when the market is hot because you're tempted by the cash grab. Remembering that we're trying to achieve a $10 million outcome here. Wealth is a long game. It's a long form game. It's not a short form game. And when you cash out, what happens is, especially now with government changes to capital gains tax, is that you're going to be taxed at a really, really substantial amount. Now, the good thing with property in general is that you don't actually need to sell it to extract value from it to then expand into more assets. Now, most people, the mistakes that they make is that they put that return or that money into depreciating assets, cars, fancy things, clothes, holidays and stuff, which is good fun, but it's not how the wealthy do it. The wealthy never sell. They expand the value of their portfolio, which gives them a foundation. They then use that foundation to acquire more income-producing assets, which builds and builds and builds over time. So being patient is really important. Just touching really quickly back again on the structure side of things, there's also opportunities quite often to acquire properties through different entities, through different structures. It might be that you acquire a property utilizing a self-managed super fund or something along those lines. And that might also give you the ability to grow another $1 or $2 million in the portfolio over a long period of time. Whereas a lot of people might not know that they can do that, and it affects the outcome for them at the end of the day. Point 5, there's a couple to this, but the role of leverage and using equity, and also overcoming fear. So strategic portfolio growth through compounding, like I mentioned earlier, it's compounding growth. When you have multiple properties growing for you, it's growth on growth. When you have 2 properties as opposed to 3, one property that you might not have had might grow at 6 or 7% for that year, or 10% or 15%. If you have a look at Perth or Brisbane recently, South Australia, they've just had incredible outcomes from a capital growth standpoint. And it gives you then the ability to compound and use that growth and use that equity to get into more properties. Now, why I put fear in this is because a lot of people make the mistake of thinking that expanding into more debt equals more risk. Now, it does equal more risk if you can't manage the cash flow. This is where the wealthy don't stop. They actually grow more because they've got that foundation. And once again, if you can manage the cash flow, if you can put yourself into a property that's going to generate a stronger yield for you, remembering that's going to strengthen your capacity for the next acquisition, then there really is no risk as long as you're assessing it properly. Once again, going back to working with an expert so that they can assess it properly for you and make sure that you're getting yourself into something without overextending from a financial standpoint. So I see fear win a lot of the time with people, and it's really disappointing to see, because I really think that love is the way. And I'm not trying to get deep here, but love over fear every day of the week is the best approach in my opinion. And quite often fear is misunderstood, and we let it win when it's once again working with that expert who can explain that for you and explain why expanding into more debt could be a good thing. Obviously, don't take this as financial advice, but yeah, I think fear is a big thing that stops people from expanding even further, and is a really big mistake that I see quite often. The other thing with fear is that's an emotion that we don't really want ever coming into the decision when it comes to purchasing an investment property. Investment property purchasing is purely a logical decision. It's not about the color of the curtains or the floor plan or the size of the backyard. Sometimes it's got to do with the size of the backyard, but it's got to do with the dollars and cents. Acquiring investment properties is done with a calculator, knowing the numbers before and after tax, what it's going to cost you to hold, what kind of tax return you're going to get, what kind of numbers it's going to be to hold that property before and after tax. So it's not an emotional decision. If you're buying a house to live in, of course it's emotional. It needs to be in a good location that's close to school for your kids, and it needs to be close to work ideally, and it needs to have friends and family around, and all of those kind of things which are emotional drivers to making a decision. But when it comes to investment, firstly, we're not limited from a geographical standpoint, which reminds me from a mistake standpoint, people trying to buy something that's just close to where they live because they're familiar with it, when really there's probably much better areas that will suit better return in a shorter period of time, might have better returns from a yielding standpoint, which gives you that ability to expand into more properties as well. So never let emotion get in the way of making an investment decision. It's a critical mistake that I see quite often. We really want to be logical here. And that also means not expanding too quickly as well. As I mentioned, also, we want to be making sure that we can manage that cash flow, and we're going to be protecting ourselves for the future. So in closing, at the end of the day, building a large property portfolio isn't really about chasing a number. It's about creating long-term options, flexibility, and financial security over time. And while a $10 million portfolio might sound far away, most successful investors didn't get there through one perfect deal. They got there through consistency, strategy, and staying in the market long enough for compounding to do its job. If there's one takeaway from this episode, it's this. You don't need to have everything figured out today, but starting with a clear plan matters. Now, if you enjoyed this episode, make sure to subscribe, leave a review, or share it with someone who's thinking about building long-term wealth through property. And if you'd like to support building your own strategy, the team at Buy Fair Property Group and myself are always here to help. As I said, the link is in the description. Please book a meeting with us, and we'd be more than happy to see if we can help get you to a $10 million portfolio as well. Thank you very much.